Okay, we are going to do some practice problems. This is going to be from Chapter 12, Statement of Cash Flows. This is from the Kimmel 7th edition Financial Accounting Book, ACC 203, Providence College. And we're going to do two problems today, which if you go to Sakai, you can see the publisher's solution, but I want to walk through it so that you get a sense of what's happening here. The first one we're going to take a look at is exercise 12-10, and this is for Mitch Company. Mitch Company, and if you remember the PowerPoint presentation we had 4 steps that we want to use when it comes to preparing a statement of cash flows. The first step in preparing a statement of cash flows using the indirect method is to go to the income statement and start with net income. We then want to make some adjustments. We want to always add back depreciation expense or amortization expense, which are non-cash expenses. We then always want to add back any loss on the disposal of an asset, and we want to subtract the gain on the disposal of an asset. That's step 1. Step 2, we want to take that comparative balance sheet, and I'm going to show you, this is what the comparative balance sheet looks like. Beginning balances, ending balances. And then what you want to do right in the margin, right next to it, is calculate the changes in all balance sheet accounts. And what that means is that you take the beginning balance less the ending balance, there's the dollar change, and make an indication whether the balance goes up or the balance goes down. Third step is that you want to take the changes in current assets and current liabilities, and you want to make adjustments to net income for those changes. And if you remember, there was a little chart that we used. So we had a current asset and a current liability. And if there was an increase in a current asset, you wanted to subtract the difference from net income. If there was a decrease, in current asset, you wanted to add the difference to net income. So these are what? Adjustments to net income. Adjustments to net income. So if you have an increase in a current asset, you want to subtract the change from net income. And if you have a decrease in a current asset, you want to add back the difference. On the liability side, a current liability side, if you have an increase in a current liability, you want to add the difference back to net income. And if there's a decrease in a current liability, you want to subtract that difference. That is a very helpful tool when it comes to preparing statement of cash flows. So that third step says changes in current assets and current liabilities are adjustments to net income. The fourth step is the changes in long-term items, long-term liabilities, long-term assets, and changes in equity go into the financing or investing activity section of the income statement. And then lastly, there is a portion, there are non-cash transactions, non-cash investing and financing activities. Those do not go in the statement of cash flows at all. They are either a footnote or listed below the statement of cash flows. So let's take a look at this exercise 12-1, and you have it in your textbook, and it starts out with a comparative balance sheet, 2021 versus 2022. You are then given some additional information. There is no income statement here, but you only need certain information from the income statement, namely net income, and then some other items which are listed in this other information, additional information. Net income for 2022 was $93,000, depreciation expense $34,000, cash dividends paid $39,000, bonds payable amounting to $50,000 were redeemed for cash, $50,000, means they were paid off. Common stock was issued for $42,000 cash. No equipment was sold during the year, and land was sold for its book value. Book value being original cost minus accumulated depreciation. There is no accumulated depreciation associated with land, so just for the change in book value. So it says here, prepare statement of retained earnings, statement of cash flows for the year. So you always want to have the title of the financial statement, which is the name of the company, the name of the financial statement, and for the period. So in this example, it's for the period ended 12/31/2022. So there are three sections to the statement of cash flows. First, cash flows from operating activities. Second, cash flows from investing activities. Thirdly, the cash flows from financing activities. And I would suggest there is a fourth section of the statement of cash flows. That is the reconciliation. That is where you take the net increase or decrease in cash, add that or subtract that from the beginning balance in cash, and it should give you the ending balance in cash on the balance sheet. So I'm going to abbreviate cash flows from operating activities. And we always start with what? Net income. In this case, they told us it was $93,000. And then we want to make some adjustments. Those adjustments, first of all, would be to add back depreciation expense. Again, they gave us the number in the additional information, $34,000. There were no gains or losses from the sale of any assets. You're not always going to have those, so we don't have to worry about adding back a loss or subtracting a gain. But there is, so what you want to do is kind of work your way down the comparative balance sheet. The change in cash is not something that's shown in the statement. That's something we reconcile to at the very end. The first one is accounts receivable. Accounts receivable goes from $76,000 to $88,000. That's an increase. And remember, if a current asset increases, you're going to subtract that. So it's increase in accounts receivable. You're going to subtract that, put it in brackets. Inventory is a decrease. You look at the comparative balance sheet, it goes from 189 to 167. That's a decrease of $22,000. Remember, a current asset that decreases, you're going to add it back to net income. On the balance sheet, there are no other current assets. The next one is land. That's long term. And we'll deal with that later. So we want to look at the liabilities. We have accounts payable. Goes from $43,000 to $39,000. So we have a decrease in accounts payable. And remember, you have a current liability that goes down. You want to subtract that $4,000. The next liability is bonds payable. That's long term, so we're going to ignore that. So we have what? We have net cash provided by operating activities. It's provided because it is a positive number. We're at $133,000. Net cash provided by operating activities. Next section we want to look at is cash flow from investing activities. And remember what that includes. That includes the purchase of new equipment, the purchase of new investments. Those would be outflows, or the sale of any assets, the sale of equipment specifically, or the sale of investments. That would be when we receive cash, a cash inflow. So we look to the additional information at item number 7. It says land was sold for its book value. So if I look at the balance sheet, I see that land went from 100,000 to 80,000. It went down. It was sold at its book value. So what that means is when we sell an asset, we have to take it off the books. To increase an asset, we debit it. To decrease an asset, we credit it. So they credited land for the difference of $20,000. That means they sold the land for $20,000. So let's call this proceeds, sale of land at its book value, $20,000. That's an inflow of cash. It goes on to say here that number 6, no equipment was sold during the year. But the equipment account began, so equipment beginning started at $200,000. Equipment ending balance was $260,000. So there was an increase of $60,000 in that account. So that means they acquired new equipment, and you know the journal entry. They debited equipment, and they must have credited cash for the $60,000. So there was a cash outflow. We'll call this purchase of equipment for $60,000. It's an outflow of cash. There are no other assets. It's just land, we dealt with that. Equipment, we dealt with that. So what we have here is we have net cash used in investing activities of $40,000. That's for that section there. Next section we want to take a look at is cash flow from financing activities. And again, going through all the balance sheet accounts, we want to make sure we account for the change in all balance sheet accounts somewhere in this. Going back to the assets, cash, the net change in cash is going to be reflected at the very bottom of the statement of cash flows. We looked at accounts receivable, we looked at inventory, we looked at land, we looked at equipment, we picked up the change in accumulated depreciation. Going on the liability side, we looked at accounts payable. The next account we have is bonds payable. So what does it say on the additional information? There's number 4, bonds payable amounting to $50,000 were redeemed for cash for $50,000. So let's call this payment on bonds, $50,000, cash outflow. Next balance sheet is common stock. And common stock goes from 174 to 216. So common stock is increased. So they must have issued additional shares of common stock in exchange for cash. So they received cash for the difference between 174 and 216, which they told you is $42,000. So let's call this issuance of common stock, I abbreviate, and it is a positive $42,000. Lastly, we have retained earnings. And what's going on in retained earnings? Well, what we're looking for specifically is dividends. But they tell us in the additional information, it says number 3, cash dividends of $39,000 were declared and paid. Paid. So dividends paid. It's an outflow of cash in the amount of $39,000. And we've accounted for the change in all balance sheet accounts. So here we have what? Net cash used. Net cash used, negative number, in financing activities of $47,000. So what we want to do now is sum up the 3 categories: operating activities, investing activities, and financing activities. So we had cash flows from operating activities ended up being a positive number of $133,000. We had cash flows from investing activities. That was a negative number of a minus $40,000. And we had cash flows from financing activities. Again, that was a negative number of $40,000. 133 minus 40 minus 47. That's a net positive, so we have a net increase in cash of $46,000. If we go to the balance sheet, we have cash beginning of $22,000 from the balance sheet. That means that we have cash ending on the balance sheet of $68,000. It should agree back to the balance sheet. So that was exercise 12-1. Let's look next at another problem. And this is going to be problem 12-7. This is the Warner Company. Again, this is problem 12-7A. And this is Warner. Name of the company is Warner. And we want to do the same thing. They're giving us some information. In this problem, they give us a comparative balance sheet. They give us an income statement, and they give us some additional information. And they're asking you to do two things here. Number one, they're asking you to prepare the statement of cash flows using the indirect method. And secondly, they're asking you to calculate, to compute free cash flow. So remember the 4 steps. Again, I'm not going to test you on the 4 steps. You want to know what those 4 steps are. Step number 1, go to the income statement. Start with net income. Then add back depreciation and or amortization expense. Then add back any loss on the sale of assets if they have them. And always subtract the gain on the sale of any assets, again, if they have a sale. Step number 2, go to your comparative balance sheet and calculate the change in all balance sheet accounts. Calculate the amount and put a little indication. Does it go up or does it go down? Third step, the changes in current assets, in current liabilities, are going to be adjustments to net income in the operating activity section of the statement of cash flows. And then 4, lastly, changes in long-term items, long-term assets, long-term liabilities, and shareholder equity accounts go into either the investing activity section or the financing activities section. So let's start with the cash flow from operating activity section. And as I indicated, let's start with net income. And from the income statement, it's very clear that net income is $32,000. And as I've indicated, again, you always want to add back depreciation expense. And that number, although is not indicated on the income statement, is provided to you in the additional information. Specifically says item 1, depreciation expense was $17,500. There are no gains or losses on the sale of assets, so you don't have to deal with them. But remember, if there was a loss, you'd add it back to net income. If there was a gain, you would subtract it. So now what you want to do is go to the balance sheet and calculate the changes in all balance sheet accounts. Dollar amount, and if it goes up or down. Step number 3, we want to look at the changes in current assets and current liabilities and see what's going on. And we very clearly see that there is an increase in accounts receivable. And because there's an increase, we are going to subtract it. Remember, an increase in a current asset is a subtraction from net income. Inventory goes from $20,000 to $28,000, so there's an increase in inventory of $8,000, and we're going to subtract it. Accounts receivable and inventory are the only two current assets. Everything else is long-term. Let's then go to the liability section, and we look at accounts payable. Accounts payable goes from $15,000 to $19,000. It's an increase of 4. We're going to add that back. Increase in accounts payable. We're going to add the $4,000. Income taxes payable. The change in income tax payable always is shown in the operating activity section, whether it is current or long-term. So we have what? Income tax payable goes from $8,000 to $7,000. It's a decrease. We're going to subtract it from net income. Decrease in income tax payable, IT payable, just abbreviating, $1,000. It's a decrease. There are no other current liabilities, so we are looking at a number here. We have net cash provided. It's provided because it's a positive number when you do your math, of $38,500. Cash flow from operating activities. Let's take a look at the next section. The next section, as you now know, is cash flows from investing activities. And primarily these are the changes or activity associated with long-term investments. And let's start with the additional information. This says item 3, during the year equipment was sold for $8,500 cash. This equipment cost $18,000 originally and had accumulated depreciation of $9,500. So let's think about it for a minute. They received $8,500 cash, and that's a cash inflow, isn't it? So that's what they received. What did they give up? They gave up the book value of an asset. The original cost, they said, in the additional information, was $18,000. The accumulated depreciation, they just said, was $9,500. The book value of the asset given up was, therefore, $18,000 minus $9,500. The book value was $8,500. They received $8,500. They gave up $8,500. The gain, the loss, was 0. That's why you didn't have to report anything as a gain or a loss, because the gain or loss was 0. Even though they sold something, there was no gain or loss, so you didn't have to deal with it. But the number that's important here is that one right there. That is the cash received. So we're going to say proceeds, sale of equipment, $8,500. That's a cash inflow. That's a positive number. We see no other purchases going on. That's the only item we have. So we have cash, net cash provided by investing activities, $8,500. That's it. There's only that one piece of information. Next section. Cash flow from financing activities. And again, you want to make sure you've accounted for the change in all balance sheet accounts somewhere. Accounts payable has been taken care of. Income tax payable has been taken care of. Leads us to bonds payable. Bonds payable went from 33 to 17. There's no indication of any additional information. So it went from 33 to 16. That means it went down. Bonds payable went down, so they owe less. They owe less because they must have made a payment. So let's call that payment or redemption. Either one is fine. Payment or redemption of bonds. By the difference, right? 33 minus 17 is $16,000. They made a payment. It's a decrease in cash. It's an outflow of cash. Next account is common stock. Common stock went from 14,000 to 18,000. Common stock goes up. They must have issued additional shares of common stock in exchange for cash. So they must have received some cash. Call this issuance of common stock. $4,000. $4,000 inflow of cash. And then it says here, specifically says in the additional information, dividends declared and paid were $20,000. Dividends paid, they said the amount was $20,000. It's an outflow of cash. Got 4,000 positive, 36,000 negative. So they had cash, net cash used in financing activities, $32,000. It's a negative number. Cash flow from operating activities, cash flow from investing activities, cash flows from financing activities. Let's see what happened on an overall basis. Let's summarize each category. Cash flow from operating activities, we said that number was a positive 38.5. Cash flow from investing activities, we said that was a positive $8,500. Cash flow from financing activities, we said that was a negative $32,000. So we have negative, so we have net increase in cash of what? $15,000. We have beginning cash from the balance sheet of $20,000. We have ending cash, therefore, of $35,000. If we look back at the balance sheet, ending balance in cash, $35,000. It works. Statement of cash flows on the indirect basis. The second item is asking for us to calculate free cash flow, which equals what? Cash flow from operating activities minus capital asset purchases. Let's do this another way. Free cash flow. Cash flow from operating activities minus capital asset purchases less dividends, right? Cash flow from operating activities, 38.5. Did they purchase any capital assets? No, they didn't purchase anything. 0. But they did pay dividends, $20,000. Free cash flow, 18.5. That's it for Chapter 12, Statement of Cash Flow Solutions. Thank you.